Welcome back, everyone, to Behind the Keys, the show where we try to unlock some of the trickiest doors in real estate. Today, I want to kick things off with a question that might ruffle a few feathers, but I think it's absolutely crucial for anyone dreaming of owning their first home. What if the greatest risk facing first-time homebuyers today isn't the market itself, not interest rates, not even a lack of inventory? What if it's actually a profound misunderstanding of affordability? We see so many people getting pre-approved for a certain amount, and they instantly equate that to financial readiness. But are those two things really the same? I'd argue they're not even close. In competitive markets, we often see this intense emotional pressure, this urgency driving folks to make rushed decisions, stretching themselves thin, all because they've been told they can afford a certain price tag. But is can afford the same as can afford comfortably and sustainably for the long term? I don't think so. We need to move beyond these urgency-driven transactions and start thinking more strategically about what responsible homeownership really requires. It's about sustainability, long-term thinking. And frankly, some of our common industry habits might actually be contributing to this misunderstanding. Mr. Cham, you've been in the trenches with countless buyers. What's your take on this idea that pre-approval is being mistaken for true financial comfort?
Dwayne, you've hit the nail right on the head. It's a critical distinction that so often gets blurred, especially for first-timers who are already navigating such a complex and emotionally charged process. Pre-approval at its core reflects a lender's assessment of your borrowing capacity. It tells you how much money a bank is willing to lend you based on your income, your credit score, and your existing debts. It's a snapshot of your financial health from their perspective, for their risk assessment. But it says absolutely nothing about your comfort level, your ability to live a fulfilling life after the closing, or your financial resilience if an unexpected expense pops up. It doesn't account for your desire to travel, to save for your kids' college, or even just to enjoy a nice dinner out once in a while. That's where the misunderstanding really begins.
So, if pre-approval is just the lender's green light, how do we guide buyers to truly understand their own financial comfort zone? What are the practical steps they should be taking that go beyond just what a bank says they can borrow?
Excellent question, Dwayne. The first and most crucial step is to stress test those monthly payments. Most people look at the principal and interest portion of their mortgage payment and stop there. But that's just one piece of the puzzle, and often not even the biggest piece depending on where you live. You absolutely have to account for the total cost of ownership. We're talking property taxes, which can be thousands of dollars a year and often increase. Homeowners insurance, which is non-negotiable and can also fluctuate. Then there's private mortgage insurance, or PMI, if your down payment is less than 20%. And people often forget or severely underestimate maintenance costs. Things break, roofs need repair, appliances need replacing. A good rule of thumb I tell my clients is to budget at least 1% of the home's value annually for maintenance, maybe even more for older homes. That's a significant amount of money that doesn't just appear out of thin air.
1% annually? I think a lot of first-time buyers have absolutely no concept of that. They think, oh, I'll deal with it when it happens. But what happens when it does happen and you've drained every penny just to close?
Exactly. That leads directly into another huge point, preserving liquidity after closing. This is so vital. It's not just about having enough for your down payment and closing costs. You need an emergency fund, a robust one, ideally 3 to 6 months of living expenses, which now include your new, higher housing costs. Many buyers get so focused on hitting that 20% down payment threshold to avoid PMI that they completely deplete their savings, leaving them vulnerable to any unexpected financial hit, a job loss, a medical emergency, or that sudden plumbing disaster. Any of these can derail their new homeownership dream if they haven't maintained a healthy cash reserve. It's not about being able to make the payment, it's about being able to absorb life's blows while making that payment.
That's such a crucial point, Mr. Cham. The idea of depleting your savings just to hit a specific down payment percentage, when that very act might be putting your long-term stability at risk. It's a paradox, isn't it? People are trying to be smart by avoiding PMI, but in doing so, they're creating a different kind of financial vulnerability.
It absolutely is a paradox, and it's one that often comes from a place of good intention but perhaps incomplete information. There's a lot of well-meaning advice out there that says 20% down or bust. But for many, especially in today's market, that 20% might mean liquidating all other assets, tapping into retirement funds, or, as we just discussed, leaving themselves with dangerously low cash reserves. Sometimes it's actually more responsible to put down less, pay the PMI for a while, and keep that crucial emergency fund intact. The PMI might feel like an extra burden, but it's a predictable one, and it's certainly less catastrophic than facing an unexpected $10,000 repair with an empty bank account.
That's a powerful reframing right there. It turns the conventional wisdom on its head, suggesting that sometimes the lesser down payment can actually be the more financially prudent choice. What about the pressure cooker of competitive markets, where buyers are often advised or feel compelled to waive inspections? How does that play into this misunderstanding of affordability and true risk?
Oh, Dwayne, waiving inspections is probably one of the most dangerous trends I've seen. It's often presented as a strategy to make your offer more attractive in a hot market, and from a seller's perspective, it certainly is. For a buyer, though, it's akin to buying a car without ever looking under the hood or taking it for a test drive. You are essentially taking on unknown risk, and that risk often translates directly into future financial costs. Imagine buying a home only to find out a few weeks later that the roof needs a full replacement, or the HVAC system is on its last legs, or there's a serious plumbing issue. Those aren't small fixes. Those are tens of thousands of dollars that were completely unanticipated. And if you've already stretched yourself thin just to afford the purchase price, where is that money going to come from? It's a gamble, pure and simple, and it often costs far more than the initial savings or competitive edge it might have provided.
It's like trying to save a little on the front end only to expose yourself to massive potential costs on the back end. It really ties back to this idea of short-term thinking versus long-term sustainability. People are so focused on getting the house that they lose sight of keeping the house comfortably. So, what's your advice for a first-time buyer facing that kind of pressure? How do they resist the urge to waive inspections when they feel it's the only way to compete?
It's tough, I won't lie. It requires discipline and a strong partnership with a real estate agent who truly has your best interests at heart, not just closing a deal. My advice is this. First, educate yourself on the potential risk. Understand that if you waive an inspection, you are signing up for all potential unknown costs. Second, consider a pre-inspection if the seller allows, or at the very least a walkthrough with a general contractor who can give you a quick, albeit non-binding assessment of the major systems. It's not a full inspection, but it's better than nothing. Third, be prepared to walk away. And that's the hardest one, I know. But if buying a particular house requires you to take on a level of risk that threatens your long-term financial stability, it's not the right house for you, no matter how much you love it. There will always be another house. It might take longer, but the peace of mind is invaluable.
That takes real courage, especially in a market where fear of missing out, or FOMO, is so prevalent. The idea of walking away from something you've fallen in love with, that's a tough pill to swallow. But you're essentially saying that true smart buying decisions are the result of discipline and education, not emotion or pressure. It's about being strategic, not reactive.
Absolutely, Dwayne. It's about shifting your mindset from how much can I borrow to how much can I comfortably afford and sustain for years to come. This involves creating a detailed budget not just for the mortgage but for all the associated costs. I encourage my clients to factor in utilities, which can fluctuate wildly depending on the season and the home's efficiency, landscaping, potential HOA fees, even the cost of commuting if the new home changes their work route. Everything needs to be on the table. And then, once you have that realistic picture, you have to be honest with yourself. Does this leave me enough to live, save, and enjoy my life? If the answer is no, then the price point you're looking at, regardless of pre-approval, isn't truly affordable for you.
I mean, that's such a refreshing perspective, Mr. Cham, because it's not about just getting a house. It's about getting a home that enhances your life, rather than becoming a financial burden that restricts it. It forces buyers to look inward at their own financial habits and goals, rather than just outward at what the market is doing or what a lender is offering.
Precisely, and it requires a multi-year financial outlook. Homeownership isn't a sprint, it's a marathon. What are your career prospects like? Do you anticipate income growth? What about potential life changes like starting a family or further education? These aren't just abstract ideas, they have real financial implications. A home is often the largest financial commitment someone makes in their life, and it deserves that level of deep strategic planning. Short-term gains or quick wins can often lead to long-term pain. We want our first-time buyers to not just buy a home, but to thrive in it.
Thriving in it. That's a beautiful way to put it. So for our listeners, let's recap this vital shift in thinking. It's not just about a lender's pre-approval amount. It's about building a robust budget that includes all the costs, not just principal and interest. It's about preserving liquidity, having that emergency fund post-closing. And it's about clear-eyed risk assessment, especially when it comes to things like waiving inspections. Essentially, becoming an educated and disciplined buyer rather than an emotionally driven one.
And remember, finding a good real estate agent, one who truly educates and guides you through these principles, is paramount. An agent who prioritizes your financial well-being over a quick commission is an invaluable asset in this journey. Don't be afraid to ask tough questions, and don't be afraid to walk away if a deal doesn't align with your long-term financial comfort and goals. Your future self will thank you.
Your future self will thank you. What a fantastic way to conclude, Mr. Cham. It really puts the responsibility and the power back in the hands of the buyer. Thank you for shedding such important light on what true affordability means for first-time homebuyers. This has been an incredibly insightful conversation. And to all our listeners, thank you for joining us on Behind the Keys. We hope this episode helps you move beyond urgency and towards truly responsible, sustainable homeownership. Until next time, be smart, be strategic, and always look beyond the surface.